Welcome to the Everything Apartments podcast. I'm your host, Eric Christopher. I'm president of WSC Realty Advisors here in Long Beach, where I've been an apartment broker, owner, and property manager for the last 15 years. This podcast covers all aspects of multifamily investments, from buying and financing properties to day-to-day operations and management, and also into reinvestment strategies to help you increase your net worth. We have a great topic to cover today and a great guest, so let's get right into it. There are a lot of different ways to own apartment buildings. You can be a single owner, you can grab friends or family and start a partnership. I guess you could even say investing in a publicly traded apartment REIT is another way. Real estate syndication is another ownership mechanism that's been carried on for many decades. It offers the syndicator the ability to add a skill set and a small amount of capital to create value in an asset that will help the other more passive investors in the group. As I mentioned, we have a great guest to join us today. Darrin Mainstain is principal and co-founder of Cadence Capital, an apartment syndication firm here in the Los Angeles area. Darrin has been in the apartment investing space for 10 years and has spent the past 2 years serving as sponsor for that syndication group with assets here in Long Beach, as well as other parts of Southern California and now actually out of state, which we'll cover a little bit too. Before founding Cadence Capital, Darrin was a senior equity analyst at AMI Asset Management in Los Angeles. They're a registered investment advisor. Darrin was responsible for coverage of stocks in the industrials, materials, and energy sectors. Darrin began his career working in television literary representation with firms like United Talent Agency and William and Morris after graduating from USC. Darrin, great to have you with us. Thanks so much for joining us.
Thanks for having me, Eric.
So before we get into business, it was interesting in your bio was that you have an affinity for LA Kings hockey. I'm a huge hockey fan too. I'd say I'm more on the Duck side of town, as my son grew up playing in their youth program and I got to know some of the players. And even though I hate that name for a hockey team, kind of more, more familiar with them. But what the heck happened to these two teams? We went from both making it into multi-rounds in the playoffs, almost where we were going to meet in the semis to finalize who's going to go to the big finalized tournament. I mean, what do you think happened to the Kings this year?
I don't know. It's been a rough few years. I was at the game where they won the cup back in 2014, and since then it's been rough going in Southern California. Southern California hockey was the hottest thing then, and it's been a rough go here.
Yeah, it's funny for quite a while. The Ducks were kind of the flip side is they would have one of the top maybe 2 or 3 records in the regular season. They would just kill it all year and they'd get into the Stanley Cup and lose in the first round. It's like, come on, guys, when are you going to flip this thing around and win when it matters, But
Yeah.
I'm glad to see, some people sitting in the stands. I mean, I don't know about you, but a hockey game is my favorite sport to watch live, and really looking forward to getting back in the rink and seeing some puck at some point.
Absolutely. I didn't play hockey growing up, so I fell in love after going to games and seeing the excitement at Staples Center, and became a huge fan and have followed them ever since.
Yeah, definitely Staples is a great time for some hockey. So also in your experience on your bio was your travel from, say, starting out in the entertainment industry to then paper equities and then into real estate. And there obviously may have been a little overlap there. So tell me real quick, how did you get started investing in apartments?
So yeah, out of college, I started in the entertainment industry. During college, I had thought I had wanted to be a sports agent, and I had tried to get an internship at some Southern California sports agencies. That didn't work out, but I was able to get a job at a talent agency, and I thought maybe I'd transition to sports through that avenue. But while there, I decided that wasn't my passion, was not to be an agent in that sense. And so I started to explore job opportunities sort of along my background, which is economics major. And I got the opportunity to go work at AMI Asset Management, and I was there for some time covering stocks. But while I was there, the company I worked for, while they managed clients' assets and stock and bond investments, they would also partner with other real estate syndicators and help them raise their equity money on big institutional type equity deals where, the raises were anywhere from $10 to $30 million. And so I would co-invest in those deals that they were raising money for. And that was sort of my introduction into apartments, was as a small limited partner investor in larger institutional real estate multifamily syndications. So during that time, while I still worked at AMI, I became very interested in, trying to invest in apartments on my own. And I went out and sort of put together a mini friends and family syndication. Really, it was just my wife and I, my parents and her parents were the three investment partners in my first syndication. But we treated it, sort of structured it more as an institutional investment to try and learn that business. And so I went and I just pulled the trigger and did it. Bought a building in Long Beach, 9 units, and that went well. And then after, having done those small friends and family syndications, I decided one day back at the early 2019 that I was going to quit my job and give this a go full time. It was a risky bet. I really didn't have a track record. I didn't have investors lined up to invest. I just said, you know what, if I'm going to do this, I need to do this full time or it's never going to happen. So I quit my job. I met my partner, Alex Merman. He had a background in single family development, but really a construction background. So my finance background and his construction background, we brought that together and we started buying apartment buildings in Long Beach.
Between the two of you, it sounds like a Reese's peanut butter cup. Perfect combination. You've got the financial side covered. He's got the sticks and bricks side covered. So that's great. And you know what? I don't think you disagree that there's a little hair-raising time when you're like, I'm moving away from a safe, secure job and I'm going to go be an entrepreneur. I don't know about you, but I've never looked back and regretted doing that.
No, I mean, it turns out to have been the best decision I could have made, but at the time it was risky and, conversations with my wife. I had two really young kids at the time. So I was like, I had planned for this and understood that it was going to take some time to get back to the level of what I was leaving in terms of my career. But, I'm a big believer, if you're going to do it, you got to go all in or you're not going to give it your full attention. And I tried to syndicate more deals while I was still at AMI, but it never really came together. I couldn't put my full focus. I couldn't be down in Long Beach all the time, seeing deals. I really had to commit.
Right, right. Well, kudos to you for doing that. And obviously they say the rest is history and it's certainly been going well. So let's dig into this a little bit because even I was part of a small syndication fund years back where we were a vulture fund, pretty small one, buying single family homes in the bottom doldrums of the recession out on the 15 corridor. The thing rent really well, but I was mostly in charge of capital raises, tapping my apartment clients and just, again, friends and family, putting the money in, but I didn't really understand the mechanics of it. So let's go through. You just executed on a 34 unit property in Phoenix, and we'll kind of talk about that going from Long Beach to out of state, which is another huge topic we could spend a whole nother hour on. But let's go through some of the nuts and bolts on this stuff. So looking at your prospectus, you source the deals, obviously. You're on the radar of a bunch of brokers all over town and now I guess out of state as well. So you found this 34 unit. What was it for your syndication versus just buying a hold long term? Because I think you have like about a 5-year horizon on your hold. Is that kind of your normal?
That's right. Yeah. So we underwrite to 5 years, but we look at these properties on a year by year basis and actively manage the asset and make decisions every year. Is this the time to sell or is this the time to hold? So while we underwrite to 5 years, we could sell the property anytime from, a year after stabilization or hold it for 10 years, just depending on, market conditions and what we think the value is at any particular time.
Absolutely. Okay. So you see this deal in your crosshairs. It makes sense. Now, are there differences in how you look at a deal like this when you say, that's a green light, let's go strike at this thing for my 5-year horizon, vis-a-vis, let's say something longer term hold, without, again, giving me your trade secrets up, what do you look for primarily when you see something that you really like, or what rings out to you in it?
Yeah, I mean, there's two sort of overarching metrics that we need to hit in order to move forward on a deal, particularly a syndication deal. So the two would be, what is my cash flow once the property is stabilized over the hold period? And out of state in Phoenix, we're really looking for at least a 7% cash on cash return over the stabilization hold period. And the second thing we're looking at is, what is the IRR over the hold period? So we're looking for anything north of 13-14% in this market. Used to be higher, but in this market, I would say 13 to 14% IRR or higher would be something that we're interested in. I would say that that differs from an investor who may be looking to hold for the long term, in that if I were looking to hold, maybe continue to refinance the property, but just hold it, without a definite exit date, I'd be much more concerned about only the cash flow as opposed to what my IRR is based on some exit price.
Absolutely. And then IRR, that's everyday usage for an institutional guy. A lot of mom and pop, they may not consider that because again, they're not on a 5-year window. They're on an indefinite window.
Right.
A lot of emotion involved in that. Just real quick, without going too deep into the weeds, what does the IRR do for you? Maybe just real quick.
It just, very basically, it's a measure of your annualized return over a hold period. So from buy, cash flow, and sell, what am I earning annually on that investment? So 14% IRR roughly equates to a 14% annualized return over the hold period.
Now, in that IRR, you're making assumptions about appreciation over the 5-year period, I'm assuming.
Yes. So,
Okay.
we buy the property at a particular cap rate. And what we look for is to stabilize the property at a cap rate higher than we think we will sell the property at. So as an example, this Phoenix deal that we just closed on, we estimate that we will be able to stabilize the property after all renovations are done and new leases are put in place at a 6 cap. Now, if you can do a little bit better on rents than you think, you might stabilize at a 6.25 or 6.5 cap. And then you try and make your value add spread on the sell, where things in Phoenix, stabilized properties are selling at a 5 to 5.25 cap. That differential there leads to the value that you may add to the property, or the value that you're able to create in the property.
So you've got your whole value add component built right into that number.
Yep.
Okay, great. So you're going to go take this thing down. It checks all the boxes. I hate that phrase, but it's just so prevalent now. It checks all the boxes, but it does. It checks all the boxes. You fire off an offer to the broker. Now, when that goes under contract, how does the funding start? Is it you all are funding the deposit, and how does that? Give me a quick timeline on you're under contract, and how does the capital accumulate? Let me actually back up.
Sure.
In your capital stack of your investors, your partners, are those people ready, standby? Have they committed, like, okay, I want to invest with you. When you're ready, I have X dollars for you? Or because to me, it seems like there could be flight in and out, where somebody's hot today and then you find the perfect deal, and somebody who you're relying on to be part of that deal goes, oh yeah, I did something else. I mean, how does that coordinate when you get a deal like this?
Yeah, I would say that's, so we put the property into contract, we self-fund the deposit, and we self-fund the due diligence costs. We go out to Phoenix, we do an inspection on the property and decide if we are going to remove our contingencies and move forward. Before we remove our contingencies, we're having preliminary conversations with investors. And we have a good idea that we will be able to raise the equity that we need to raise in order to close. But we don't have what I would consider a discretionary fund. Investors don't commit ahead of time and then have us go out and find properties. We find the property first and then go sell it to investors. So there is a risk that investors may, there may be some flight between, once we commit to a property and it's ready to close. But luckily we haven't run into that issue yet. But yes, we're putting the deposit down ourselves, and we're spending the cost for the inspections and to go out to Phoenix and all those sorts of things.
Okay. So you've got a group of investors that through the time you've done this is presumably building, without giving your trade secrets away, these are passive folks. Let's say, are they doctors, friends of friends? Like, you have any profile on who really enjoys doing the passive side of your equation?
Yeah. So the first property we did was a small 6-unit property in Long Beach. So we didn't need to raise as much equity. And we started with close friends and family that we knew we knew were interested and had spoken to beforehand. As time has gone on, we market ourselves, we network, calling people who may be interested, but really it's a referral business. Friends who have done well with us or family have done well with us refer us to other investors who may be interested. And as our track record builds and we continue to deliver on deals, we just are able to generate more interest. So like I said, we started out with a 6-unit property. I think we needed to raise $600,000 in that range, $700,000. And on this latest deal, we raised close to $3 million. So it's been, one deal is bigger than the next in terms of the raise. But that's really our job as a syndicator, is going and finding the deals, locking the deals down, and then going and raising the money.
Perfect. So you're finalizing that during due diligence. So during contract before contingencies, and you'd rather have a longer contingency period than a shorter one, but on competition deals, you're not going to get it. So you got to work pretty quick. You got to work pretty quick to get ink on those commitments during the due diligence. Yeah.
On the bigger deals, on the smaller 6-unit deals in Long Beach, we may have had a 7-day due diligence period. On some of the bigger deals that we're doing now, 21-day due diligence is not unheard of. And as you go into even bigger deals, you may be able to get longer due diligence periods. But yeah, that is where we're doing that initial raise. We don't have all the money committed by the time we have to remove contingencies, but we have a good idea that we're going to be able to raise the money.
So you may, so it sounds like you may, if you have the lion's share of the funding committed, you may take it on spec that the other part will show up as you move forward and fill in the blanks. Or would you take a little larger position yourself, maybe, or,
Yeah.
It sounds like that. Okay. So now you've got this thing under contract, you remove contingencies because you got your capital stack built up. And then as far as where you're going in on the look, the first time somebody would look at this and say, well, these guys equity wise don't have a whole heck of a lot of skin in the game. How do they make money? First thing that would come to mind would be an acquisition fee. So you make money when the deal is closed?
Correct. So we make money when the deal is closed. We charge an acquisition fee. We charge a small asset management fee over the life of the deal. But then the lion's share of our return comes from what's known as your promote. So we offer investors what's known as a preferred return, meaning all profits are split equally among the investors up until they've reached that preferred return. So on this latest deal, it was 7% return. So once investors have received a 7% annualized return, then we take a larger share of the profits. On this particular deal, we then keep 30% of the profits, and the remaining 70% of the profits are split among the passive investors pro rata.
Great. Okay. So it looks good to a passive guy saying, hey, I can make 7%. And certainly if I make that, I'll be glad to share a little bit of the windfall with my syndicator. So now we've got the acquisition done. We now own a property in Phoenix. Now, for a lot of listeners, this new out-of-state thing it's become a bigger thing, right? Ever since I started my career, you'd hear kind of maverick investors going, yeah, I went to Texas or I went to Arizona. That wasn't as big of a stretch, but I went out of state, and there was guys doing that since I started, but not a lot. And in the last couple of years, like I mentioned to you, maybe I visited some of these markets for the purpose of getting to know them. Reno, Tucson, I'm going to Salt Lake City in a few weeks, Phoenix. Over half of the deals that are being sold in those markets are going to California buyers right now. It's the same story from every broker I talk to. So what is it now that you do? You go, okay, I'm relatively new in a market like Phoenix or anywhere else. Management, tell me about that. You did a bunch of interviews, but secondarily, you're going to spend a bunch of money in the way it looks like could be $900,000+. Who do you know? How did you get comfortable with the third party folks you're going to be dealing with over there?
Yeah, so we knew some people who had invested in Phoenix previously, and we asked for referrals to brokers, referrals to property management companies, and referrals to contractors. And we had actually planned a trip out to Phoenix just to meet people. We didn't have a property in contract or anything like that, but we had planned a trip just to go out and meet people. Lo and behold, during that time, we actually put our first property into contract. So we had called all these people. One of the brokers we had been speaking to for a while is like, look, I got this deal. If you're interested, why don't you make an offer? It was a deal that we had looked at, we liked it, and so we made that offer and put it into contract before we went out there. So that first trip where we were just supposed to meet people turned into a property inspection, a due diligence trip, and meeting people. So it was pretty fortunate. But yeah, I mean, we interviewed people, we got comfortable with them. There is an element of trust. Having the referral to someone, someone who had bought 2 properties in Phoenix and had used some of these people and really gave them high marks, made us feel comfortable. But we sort of had to take the leap that, they were going to perform based on how they had performed previously with other people that we knew.
And it would sound to me, based on the timeline, that this project is probably in full swing now, meaning you've got contractor vendors and the whole surgical process underway. Is that happening right now?
Yeah, so that first property we bought in August of 2020 in Phoenix. And that one, we're almost done with the full renovations, at which point we will refinance into more permanent type debt and plan to hold the property for some time. But yeah, it's gone really well. And that gave us the confidence to continue to use this team that we've developed there on future deals.
And that brings up a question, because what I would guess is that when you're buying this thing, for example, this 34 unit with under market rents and just outdated everything, you going with hard money on that for a short period of time, or what? Because you said you're going to go get a takeout loan
Yeah,
for the perm, so you're using hard money on the acquisition.
it's a private debt arrangement that we have.
Oh, okay. All right.
Yeah,
So you got some, basically, whatever it is, temporary financing to get you stabilized, to get you where you want the value to be, to then take the long-term financing out.
correct.
Perfect. Perfect. Okay.
It gives us an advantage in that this debt is drawable debt. It's not tied to any property. So we are able to make all cash offers, and it makes us more competitive when we are trying to buy.
Oh, that's a huge thing, right? I
Yeah,
mean, you're coming in saying, if I can get the capital built up on a deal, I've got an all cash offer and a short due diligence period. You're going to win a lot of those games.
yeah, we don't have to put any financing contingencies in our deals. So we feel pretty
Wow.
confident. We have a great mortgage broker that we use. So we talked to him before buying the deal about what sort of takeout we're going to be able to get once we stabilize the property and back into our initial debt financing based on those numbers.
Perfect. Okay. So that leads to the question. You said something really interesting, because, again, going back to mom and pop investors, some of them are sticking their toe in out of state, and that Phoenix market is like, hey, that's the closest thing across state lines. People have always been a little skittish of Las Vegas, just for a few reasons. Phoenix has been the benefactor of huge population and job growth, and the apartment market is steaming along over there. That's
Mhm.
the doorway. I think you mentioned the word doorway, which makes very, very good sense as to why. But you said something more interesting. You said, hey, I went to Phoenix and it worked. Why wouldn't it work in other states? So you're going bigger picture now. Tell us a little bit about that.
Yeah, I mean, Phoenix is an incredibly competitive market at the moment. Buyers are plenty and deals are not as plentiful at the moment. So it's hard to find deals in Phoenix, but as syndicators, we want and need to continue buying deals. So we're starting to look at other markets. And we don't have the same referral source to other markets that we had in Phoenix, but we know what we're looking for in a property management company. We know what we're looking for in a contractor. And really, we're confident that we will be able to find those vendors in other markets. The biggest hurdle is making good relationships with brokers and finding deals in other markets. And having done out of state deals gives you some credibility to go on and find the next deal. I think the first deal is the hardest deal to find. Like you said, almost half the deals in Phoenix are being bought by California investors, and every single broker I talk to says, I talk to 5 or 6 new California investors every week who want to come out here. And so getting that first deal is tough, but once you do, it gives you credibility, and sellers are more willing to work with you on the next deal.
Yeah, I can only imagine it's the Wild West, no pun intended. But what I can see with you is you've got a track record, not just here, but now you're in Arizona, and it would make it easier for somebody. I think you might have mentioned Carolina or Florida or something. It'll make
Yeah,
it much easier for them to say, okay, it's a cash offer, great, but is this guy going to get me under contract, retrade? Is he going to close a deal, basically? And you've got track record to show these people that will add to your credibility for sure.
exactly.
That's awesome. So what states have popped up maybe further away, way off my radar? A lot of people listening. Um, you got a couple that you go, I like it because of X that you're moving into nowadays.
Yeah, we look, the Carolinas, both North and South Carolina, have been interesting. Boise, Idaho has been interesting. Really, what we will look for is population growth and job growth. Where are people relocating, and is it sustainable? Meaning, are companies relocating there as well, and therefore employees follow who need housing and make it an attractive market?
Yeah, that's the basics, right? And I've listened to actually a couple other podcasts, real estate stuff with, some really good online resources that you can sit in front of your computer and really dissect different markets in a way that you could not do 5 or 7 or 10 years ago. Just the information wasn't there.
Yeah,
And it seems like if you looked at some of the the presence or non-presence of like a lot of government overreach, I think we're probably the worst here. So like any state that you go to may be better than that. But yeah, looking at that job growth, is Amazon dropping a huge big box close by where they're going to bring a bunch of folks in to live in what was a rural market. I've got a client who's been doing that in Kentucky. He traded out of here. I said, Kentucky, how did you feel? Well, I got a relative there, but I've really been really analyzing that market. And I really like the fact that I can get a high six cap at entry and do some value add on it. I'm confident in the growth and the long-term viability. I'm going, man, 10 years ago, you just didn't have access to that information at all.
no. And, not only access to that sort of macro information, but the micro information too, between Google Maps and, rent surveys online. We're comfortable putting a property into contract before we've even been there. And then we fly out and do the inspection. We can do a good chunk of our due diligence, from our computer at home or at our office, and then go out and inspect the property and do all those things once we have it under contract. The first property we bought in the Phoenix market was actually in a more rural suburb outside of Phoenix. The property had been overlooked because of that, but we saw significant job growth there. There were Amazon, Walmart, and other distribution centers leasing tons of distribution space, millions of square feet of distribution space in these areas. And it was continuing to grow, population growing at an enormous rate. But a limited supply of apartments and not a lot of new construction coming online made it quite attractive to us. And our thesis has been proven out over this first year with that property.
Yeah, that's getting into the weeds where a lot of people may not have had to do that before. They're LA area investors. You wait for a correction in the market of some kind, or maybe even not. In the last 8 years or so, you haven't had to needed to wait for anything. But going into these more rural areas, yeah, you're talking an outskirt of Phoenix, but with a regional change that's been flushed into it, that you're going, hey, whatever I had before, it's going to be better now.
Yep.
Let me ask you this. So getting out into the other states, it doesn't really matter if it's Arizona or Florida or Carolina. What do you see as the big differences? We know, rent structures are way different in different markets, which doesn't really matter when we're talking about a percentage rate of return. But what have you seen in some of these out of state markets that you go, oh wow, like the utility expenses are way different here, or just the different operational nuances that you've noticed? Are there anything that sticks out in your mind? Property taxes or insurance? I mean, anything that you go, hey, we got to watch out for X when we go into Carolina? Any insight on that?
Well, my experience thus far, there's been two areas where the difference is stark between California and other states. Number one is property tax, significantly lower in Arizona than California. So that is, an expense savings, but it's accounted for in the price of deals and the cap rates you're able to buy deals at. The other big difference and what sort of drove us to Arizona is the lack of overregulation. So we first went to Arizona once COVID hit. We were very concerned about the regulation coming down the line in California, and we figured that Arizona was a much more landlord-friendly state, and that has proven itself out. I would say in Arizona, tenants' rights are important, but landlord rights are also important. Where my feeling is in California, landlord rights have been diminished and continue to be diminished over time.
Yeah, and that's putting it lightly, right? I mean, you know, I mean, we could go on all day about the victimization of landlords during just this last year, but the tide was raising on that even before COVID. And you start scratching your head going, okay, because I interviewed a manager in Tucson and I said, hey, tell me about your evictions over here because we really struggle. And I gave her, a normal worst case scenario. And she says, oh my God, I can't believe that it's like that over there because over here, an eviction gets done in 30 days. If it takes 30 days, that's the long end of it. It's pretty cut and dry. And like you're saying, the landlord rights they're also important. No, you and I sitting here, we're not going to try to take advantage of our tenants, but right now the tenants with the help of the government can take advantage of us and they really are, right?
Yeah.
So you get into Arizona and you go, hey, no rent control. Hey, the evictions are easier to do. It You can see why people are going that way.
Yeah.
Now, the problem that I think about long term, and I don't know if it's because I've got pessimistic of the government in general in this last year, but you look at a lot of these states going blue in the last election, you go, will these states evolve into mini Californians, bunch of California people moving there? Are are they going to evolve in a way that changes that? This is kind of a esoteric, kind of long range thought. Texas is kind of one of those places that's been very independent and also landlord friendly, but like, they've got a different population mix with so many people moving in there. I kind of wonder what the next 10 or 20 years looks like in a lot of places that used to be, let's say, very stoically red. How does that boil down to like apartment owner syndication? Just, I'm sure you've thought about that too.
Yeah, I hope things don't go as far in other states as they've gone here. I know in Arizona, there's actually a landlord bill of rights that's law in the state, which protects your rights to an extent. Um, but is that a possibility? Sure, I think that's a possibility. Is you get relocation from a lot of California people moving to other states, particularly along the West Coast. It would certainly be a headwind to the industry if that continues to happen.
Yeah, I mean, we collectively as investors in these out of state markets, I think we've got quite a period of time where there would be a systemic or change in the model. But I look at California, I'm going, we got a road to hoe here because there are a lot of high net worth people that are changing their state of residence, and then there's stuff like underfunded pension funds, and you wonder, since you and I were little growing up here, it's sort of like you buy a piece of property here, no matter really what kind of property it is, it's going to be fine over a period. You may have bought maybe at the wrong time of a cycle, but if you can hold on to that thing, you would always be fine and end up in a very sharp looking uptrend at some point.
Yeah.
My thing here that I've been talking to a lot of people about is, hey, you may never see like appreciation non-existent here anymore, but what's that curve going to really look like with taxes, with fees, all these little garden variety fees that the city of Long Beach likes to charge us, and then rent control, and then let's say they take the 1031 thing would be nationwide, but
Yeah.
all these sort of like heavier rocks on your back to keep walking forward. And at what point will your speed of progress be slowed down? What will that uptrend curve look like in a normal market in the next 10 or 20 years? And I don't, like I said, I don't mean to be pessimistic, but I feel like that trend that we're used to in an up market is gotta flatten out a little bit. And that's why I'm kind of preaching to people, get your mind around out of state because it may not be as big of a moral jump as you think once you do like you have and said, hey, let's knock one out in Phoenix and see how it works. And hey, this is pretty good. I mean, there's obviously pluses and minuses on all of it, But
Mhm.
hey, you did it and you're comfortable moving forward. And I just don't know what's going to happen here in California. It's very strange what I've seen, like you've seen in the last couple of years. You know.
Yeah, I mean, you were asking about some of the differences before, and just as an example, one of the things that we could not believe what that happened here in California was we had a tenant in a Long Beach property we suspected was dealing drugs out of the unit. And it still took us. We had evidence that that was going on, and it still took us 6 months and $10,000 to get him out of there. On top of the fact that he stopped paying rent once we started filing this process, so the lost rent isn't even included in that figure. It's just it was unbelievable to me. And so we had always thought about leaving California. Silver lining to COVID, it actually forced us to accelerate that plan, and it's worked out so far.
Yeah, well, kudos to you. And I know that other people that do this differently, long term buy and hold. I mean, it's happening when you get to talking to these brokers that they've multiple California offers. So it'll be a matriculation process of a guy like you going, well, hell, let's go to Carolina.
Mhm.
There's a ton of apartment markets across this country that are still emerging, that are going to emerge with, like you're saying, influxes of population and job growth. There's tons of product for bullish investors to look at, and a lot of it's a mental block to just go out and do it. So I think talking to a guy like you that's approached this a certain way here in Long Beach and said, "Hey, the water really is pretty good over here," and I have a hard time believing that that would subside, that we won't see a continuation of that moving forward. So I really appreciate you being here today. Any closing thoughts?
No, I appreciate you having me on and getting to answer your questions and sort of tell my story. And it's been great talking to you over the past few years, and we'll keep talking going forward.
Yeah, I really appreciate the insight, because this, like, I did my first podcast was with a developer client of mine, and everybody in real estate, no matter who you are, at some point thinks about doing development.
Hmm.
This is the same topic. Quality is, I think, anybody and everybody that invests in apartments would be able to say, wow, this is a different way to do it. I can apply my skill set, some capital, if I can accumulate a group of people that I can do a good job for. I mean, it's a really wonderful win-win model for everybody. So it's an exciting prospect of what you're doing. So I really enjoy hearing about it.
Well, great. Thanks for talking to me about it.
Yep. Appreciate it again. Well, hey, everybody, thanks for joining this episode of Everything Apartments. If you like this podcast, it's now found on Apple Podcasts. Check it out. And like every podcast you hear, give it a 5-star review if you like it. Keep us going, and we'll have more topics around apartment ownership, management, and investing coming up in the very near future. Again, I'm your host, Eric Christopher, and I really appreciate you being here today, and we'll talk to you soon.